Hi, everyone. My name is Sohail Hassan, and I am a principal and managing partner at MarketSpace Capital, which is a private equity real estate firm headquartered out of Houston, Texas. We currently have 18 investments throughout the United States across various asset classes, including retail shopping centers, office buildings, and of course, our primary focus, the acquisition and development of multifamily apartment complexes. Our current assets under management total approximately $330 million. And we started the due diligence process on blockchain and tokenization back in 2017, but at the time believed the technology and market needed to mature further. So at the time, we chose to focus our efforts on building up our assets under management with the idea of one day converting this to the tokenization model, because we understand that real estate technology has traditionally been focused on listings with connecting buyers and sellers. However, given blockchain's disruption of financial services and subsequent widespread application across industries, it's hard to find a segment that does not have the potential to be influenced by this technology, which of course includes real estate. The benefits of this technology are absolutely amazing and has the potential to address the two biggest drawbacks that are typically associated with real estate investing. And that is, of course, the lack of access because of the high cost of the ticket. You know, the typical investments for MarketSpace Capital have a minimum investment of $50,000. And of course, liquidity, because this system effectively allows for owners to sell their shares or units on a secondary market. In fact, real estate is the biggest single asset class where tokenization can provide value, 228 trillion in total assets. The real estate market shares the value proposition of the overall securities market. We view some of the biggest benefits to real estate tokenization as the ability to reduce those ticket sizes by several orders of magnitude. So you're talking about a $50,000 minimum investment down to a minimum of $1,000. This is, of course, made possible by the extreme automation of issuance and post-issuance processes, and it will dramatically increase the group of investors available to invest in a given property. Another significant benefit is the new liquidity of real estate by making real estate a tradable asset. This will, of course, increase the amount of money that's available to invest in real estate, and on the other hand, will make the asset class more interesting for investors. Of course, today non-accredited investors are largely prohibited from trading and investing in real estate. Just consider the fact that approximately 93% of all US registered commercial real estate investors are only accessible to accredited investors. So due to the excessive capital requirements, the great majority of the people in the United States and the world are excluded from investing in these real estate assets. Meanwhile, there's a growing popularity, of course, of crowdfunding platforms like crowdfunding, for example, which currently is deploying almost $50 million of capital on a monthly basis. So this indicates that retail investors are eager to access the real estate market. And as of 2018, the global real estate crowdfunding market was valued at over $13 billion and expected to grow at a compound annual growth of 58.3%. So, this intensive infrastructure calls for innovative technology. And by issuing real estate assets on a distributed ledger through tokenization, the real estate investment market could automate middleman processes, increase liquidity, lower capital requirements for investment, and improve transparency. This in turn could lower the expenses of real estate issuers and broaden the scope of potential investors. So as such, it just makes sense that the real estate industry is ripe for tokenization. And we understand that blockchain real estate applications have the ability to revolutionize the way the industry is even seen. At the very least, these proposed groundbreaking technologies have the ability to disrupt the entire industry. We're talking about from more secure transactions to shorter closing windows. Blockchain and real estate is the wave of the future. And one thing is for certain, that we're just getting started. Now is a good time to start implementing your own blockchain real estate applications and strategy. And that's what we here at MarketSpace Capital are doing as well. In addition to that, we see the primary ways that this can be implemented, just kind of as a high level ways, of course, as I mentioned, is on the trading platforms and online marketplaces. As I mentioned, CrowdStreet, there's a number of Zillow, Redfin. Imagine the ability for them to create an online marketplace. And because of these blockchain applications, more people are going to be able to start participating in the real estate industry without fear of malicious exchanges. Obviously, the second point that I mentioned was the lack of, or the lack thereof, of intermediaries. And this is where we truly believe that it will disrupt how the transactions are carried out. For example, when we are doing distributions for our investors, currently we're having to go through a process of sending out ACH wires, having the bank involved. There's an entire process that is required there that is also expensive. Now we have the ability to distribute tokens and essentially eliminate any cost that might be associated with that. That is just one example of the way that you're removing the middleman from these processes. Of course, as I mentioned, creating and allowing real estate to become a liquid asset. This is typically one of the drawbacks of investing in real estate, is the lack of liquidity. Now you have secondary approved markets like T0, for example, the only SEC FINRA approved secondary exchange in the United States. And these secondary exchanges are going to allow you to not only trade stocks and things like the other decentralized exchanges do, but they also allow you to trade to real estate assets. You'll be able to buy and sell cryptocurrencies as well. So all of this kind of plays into what allowing liquidity in what is typically seen as an illiquid asset. Another important thing is it allows for fractional ownership. So again, now you're able to get investors access to quicker capital, but it also gives prospective owners a lower barrier to entry. You no longer have a minimum investment of a $25,000 or $50,000 when you can just buy shares of the asset on a secondary exchange. Obviously, through this, it has the ability to significantly impact our cost. And we're talking about escrows being done autonomously. Being able to execute these transactions over the blockchain can eliminate the need to hire several professional services and therefore reduce costs significantly. Finally, we have the ability to digitalize our documents, and our entire platform would be supported by the blockchain, which obviously includes smart contracts. So everything, any changes to the investment, all of that is very transparently laid out in the form of and recorded on this blockchain. And so this allows complete transparency to all parties, which obviously also reduces the likelihood of payment disputes. So we've gone through this journey of understanding what the pros and cons are of investing in blockchain technology and integrating it into our platform. Now we really broke it down into kind of a different way of thinking about it, right? So on the pro side, we thought about what are those tangible and intangible pros from being able to implement this type of technology. So first and foremost, we believe that it obviously gives you access to additional capital. This allows you to open up the global market of investors. In fact, as of 2019, over 1 billion has already been raised through this tokenization efforts. Obviously, there's a growing digital market for this. As I mentioned, over $1 billion, projected to hit nearly $5 billion by 2025. All right, so this is a growing market, and this is what we see as kind of the tangible benefits and pros to doing this. Then there are a number of intangible benefits, okay? So obviously, given the option of liquidity that exists on the secondary market, investors feel more confident and will devote more investments, we say, across a wider spectrum. Additionally, we feel that it sets MarketSpace Capital apart from our competitors who, traditionally aren't able to offer liquidity to their investors. All the information that's related to the tokenized asset is completely transparent on the blockchain. So even edits, updates are all noted, and it's made available to our investors. So it's true transparency in real estate investment. Of course, we mentioned reducing back office, processes, which can cut costs. Right now, we're spending a lot of time, money, and resources in cross-referencing processes to comply with what are known as blue sky filings, which can be cumbersome. But the blockchain allows for a centralized source that contains all investment information. And therefore, we estimate in-house, when done properly, it takes about 5 hours of work in order to update the investor portal on our end to make sure that it matches the cap table for one single asset. Imagine you can eliminate all of that by doing this from the beginning and having it recorded on the blockchain. Additionally, when we've had this issue before, is that when you're manually doing all of this on the cap table, there's potential for mistakes through human error across, and that affects multiple projects. So you're eliminating the idea of human error that could potentially be, catastrophic in these types of real estate investments. The other side of it is we see that it has reduced due diligence needs, because on a distributed ledger, all of the information is kept public. So information is much easier to gather, which saves significant expenses when it comes to third-party due diligence vendors. There also maybe, in terms of the T0 platform, when you go through this platform, it's as if you're going on a publicly traded platform. The amount of due diligence that's being done from the T0 team to get you approved to trade on their secondary platform is very similar to a publicly traded company. They're auditing your financials, they're doing background checks, all of that is included as a part of this. So it makes the investors feel safer. But in the future, this is going to get more complicated and it's going to be harder to get onto these platforms. We see it as an advantage for us to be kind of one of the first movers to be grandfathered in the future for these platforms. We also see MarketSpace Capital playing as an intermediary or a consultant in the ability to tokenize other portfolios. Now, we have spent significant resources and time on this concept and have become somewhat experts, right? And let's be honest, there's obviously everybody's kind of learning as we go. But nevertheless, as we go through and tokenize one of our own real estate assets, we believe that we could have the potential to help tokenize other portfolios for partners of ours and basically allow them to free up capital so they can go out and do what they do best, which is acquire new properties, reduce operating expenses, and increase value for the overall investors. Now I'd like to go into the cons, and I think this is perhaps the most valuable part of this entire presentation, because I see a number of questions that are coming in. I think a lot of these will address as well. And certainly, ladies and gentlemen, there are cons to this. Let's be real. Here we are in 2021, and this is a growing market. And everybody understands that this has the impact to really change the way that real estate investments, not only the equity is raised, but also in the way that transactions are conducted. But nevertheless, there's limitations to this, and it's important that we understand those. And we spent a lot of time into seeing what those limitations are, and ultimately we made the decision, of course, as our board made the decision that the pros significantly outweigh the cons, and therefore we have decided to move forward with the tokenization of one of our real estate assets. So let's start off with the money that's lost from the smart contract structure. So the way that our equity investments are set up at MarketSpace Capital is that we have a 70-30 split with our investors. But first comes what is known as a preferred return. In the industry, we call it a pref. And this is basically what the investors are entitled to on their money alone. So our typical investments have an 8% annual preferred return. So for example, if you were to make a $100,000 US dollar investment into one of our real estate assets, you're entitled to an 8% preferred return, which basically means you're earning at minimum $8,000 per year on your investment. And that continues to accumulate until investors receive their initial investment back, plus any of that accrued preferred return. So if we had a refinancing event that happened, for example, in month 24, that's roughly 2 years into the investment, our investors have essentially accumulated $16,000 of preferred return. So their $100,000 investment now reflects $116,000. Now, after that refinancing scenario is typically when we start doing distributions to our investors. So we own a multifamily apartment complex. Let's say it has roughly 200 units. So we have 200 tenants. Roughly, our projects have an average of right around 92% occupancy. So let's take that number into consideration. And every month, our tenants are paying an average of $1,200 a month in rent. So we know that we're collecting $200,000, $300,000 a month in income. Now, obviously, a percentage of that is going to go to pay off the operations, the property management company, the maintenance, the lighting bill, everything. Whatever is left over goes into a bucket. And on a quarterly basis, we do distributions to our investors. Okay. Now, as I mentioned before, all of our investors, the way that our investments are structured is that those investors are entitled to 100% of those cash flows until they have gotten back your initial investment plus that accrued preferred return. So you're entitled to 100% of everything that's being collected in that bucket and distributed on a quarterly basis until you have gotten back your $116,000. Once you have gotten that back, it then goes to a 70-30 split. The investors continue to receive 70% of that income, whereas we, the sponsors, would now receive 30%. And that's how we make money. Now notice, we don't make a dime from the ownership of this asset until all the investors have received their initial investment plus any of that accrued preferred return. And then that 70-30 split continues for as long as we own this asset together. Many of our assets typically have a 5-year hold period, which allows us basically 2 years to implement our business model, to refinance the asset, and then we cash flow the asset for a minimum of 2 to 3 years from there. Upon a sale or an exit, you as the investors are entitled to 70% of those profits, where we of course would be entitled to our 30%. So now let's take that structure and apply it to the blockchain. Basically, this entire process can be automated and can be done through the distribution of tokens. Now, from our end, if it gets a little complicated, right? Because you're offering a preferred return, then a 70-30 split, but all of this can be integrated within the smart contracts. That's the beautiful thing about this, right? But, for these types of investors, investors that made a minimum of $100,000 investment, they may double their money on these investments, but for each of those investors, we are leaving money essentially on the table. And so there might be a potential from the sponsorship side, you could be potentially losing money from the distributions of these assets, which otherwise could have been kept from a sponsor side in terms of fees and other operational costs, right? The other part of this is that there's sunk cost when you go through the process of tokenizing an asset. So for a secondary market like T0, there's an initial onboarding cost, right, which is right around $50,000, and then you have to pay for an annual per token per property, so which is roughly around $20,000. So that's some cost that you're paying to be listed on this secondary exchange. Of course, DigiShares has their own cost that's related to an initial onboarding, setting up the blockchain to support this. Their costs differ across countries, but we have, and whatever that technology cost to implement, we've not only done research on DigiShares, we've done research on a variety of other platforms, and we roughly estimate that cost to be somewhere around $25,000. In addition to that, there's legal costs. You have to take your PPM, our public offering that we did, a private placement memorandum that we created, and we have to essentially convert that PPM now and make sure that legally those limited partners that are in the asset now can get transferred over to this new platform. So again, there's legal costs that are associated, and we have estimated those legal costs to be somewhere around $20,000. Finally, you have to look at it from a tax structuring strategy, particularly since this is such a new market and such a new sector. It is very important to us to align ourselves with the biggest and the best, most credible partner we possibly can. And we went and got Deloitte. So Deloitte is our tax partner on this, and they provide tax and structuring review. And as a result, we believe that estimated cost to be somewhere around $10,000 to $15,000. So it's important to note, though, that here that the sponsor, MarketSpace Capital, is not necessarily incurring those costs when it comes to the taxing side. That is incurred by the partnership. So it's not necessarily a sunk cost from the sponsorship level. So there you have it. You have the secondary market, which is roughly around $70,000 to $75,000. You have the technology to support that, which is around another $25,000. Then you have the legal to do it, which is roughly $20,000. And then you have the tax strategy. So we estimate this about $130,000 investment from MarketSpace Capital in order to be able to go through the process of being able to tokenize your asset. Now, of course, all of the costs, everything I mentioned to you is subject to change. These are all just general costs there. So hopefully Klaus and Bjorn from DigiCoins aren't upset with me for mentioning what costs might be, but this is essentially what our market study has shown. Finally, there's two other parts of this that are kind of the cons that you should be considering when you go through this process. First and foremost is the unclear regulatory structure. So this is currently recognized as a security. We have seen that it's potential for the SEC to recognize, obviously we are for that because that opens up more disclosures. It might require more frequently, disclosures there. We already filed those disclosures, so we feel like it provides more legitimacy to the industry, but there are specific documents that might, due diligence that might have to be done according to the T0 or our secondary market that might be specific to disclosure requirements that are specific to digitization. And of course, this is a maturing market and things might occur that we can, of course, would have to address. And then, of course, there's the unclear international tax structure. This is something that we've done evidence on. And again, it's unclear because there's no real process in place. And of course, this is from our understanding. Klaus and Bjorn might be able to tell you different, but essentially the tax policies that are related to it are either not defined or they're not systemized in many countries, as you know. So we're blessed, obviously, here in the United States in that we have some structure that's slowly being addressing this as you guys might have been following, but nevertheless, it's not systematized, and that process is ongoing. So we see that as a potential con as we move forward through this process. So there you have it, ladies and gentlemen. I've given you an honest review and kind of how we've got into this, from a process of understanding that this truly democratizes interest and investments into real estate. Fundamentally, we believe that this is the future. I believe in the next decade, this will be the way business is done. Maybe even in the next 5 years, we understand that this has the impact to change the way we do business. And certainly MarketSpace Capital wants to be a leader in that effort. For more information, I would direct you to the blog section on the MarketSpace Capital website, where we have written a white paper about this. As we go through and different business models and understanding different projects, we try to become experts in it and educate ourselves. And as we go through that process, we share all of that with our investors. And now at the end of the month, and perhaps by mid-September, we are tokenizing our own real estate investment. And this is for a ground up development of a 250 units in Dallas, Texas. And this is a project that is approximately $47 million to build and has been appraised by a third-party appraiser that the lender required, has been appraised at a stabilized value of $66 million. So roughly that's where we believe we can be. We know we're going to build it for $47 million, and we know that one day it'll be worth $66 million. So we see the benefit here of those investors who have coming in at the $47 million price once it's been tokenized. But as we continue phases of this construction, the value of that token is going to increase. And we know we have third-party reviews showing that it's going to be worth 66 million. So that's the value that our investors can potentially realize through this type of investments. So it has been an absolute pleasure, and thank you, DigiShares, for inviting me today. I will be available for the Q&A at the end, and thank you. Appreciate it.
Thank you very much for a really interesting walkthrough of your own experiences in this space and your opinions. There's just actually two brief questions maybe we can take now when we have you on the spot. There's one person asking, what about marketing costs? The cost of attracting investors to buy these tokens. Is that something you can say a bit about?
Good point. Yeah, good point. So all of our investments are structured as a 506c. So basically, all of them are requiring accreditation currently. So we already have a budget in place that we do for marketing for these assets. So we don't see that, that budget continues for every project, but we don't see that budget increasing significantly because we're doing it via blockchain. So there is a marketing budget that is associated with this that we do on social media, LinkedIn, etc. But we don't see that being impacted by us implementing blockchain.
Great. There's one other question here that's relevant for you, I think. So, so when you tokenize a building or a development project, are you raising 100% through the blockchain, cutting out the banks? Are you only raising something like, say, 30%?
That's a great question. Yeah. So we are raising. So we're taking a part of the limited partnership and we're tokenizing that process, right? So I believe in our case, it's right under 18% of the total limited partner investment. We're taking that 18% and we're essentially tokenizing just that percentage. Again, we're going through the process of tokenizing our very first asset. So we're learning a lot. But we envision that in the future, you could potentially, have the ability to raise 100% of that equity through the blockchain and through this process.
Thanks. Thank you very much. Thank you again.
Thank you.
Yeah, please stay on for the panel at the end.
Of course. Thank you.